One thing most politicians understand very poorly is capital allocation. But every business leader lives or dies by it. One of the key metrics for shareholders is the return on their capital. A bad takeover or investment will reduce it. A good one can make it flourish. But that decision of where to put capital also includes Australia as a country. Every company at some stage does an assessment of Australia's interest rates, its industrial relations system, our energy supply and our tax rates. So, should that company invest here or should it invest somewhere else? Where's the best return for the shareholders' money? BHP and Rio Tinto are our two biggest companies. This week, I spoke with each of their chief executives. BHP has just written down $5.4 billion on its nickel assets. And I started by asking Chief Executive Mike Henry if it made him question nickel as one of BHP's cornerstone assets.
So, Ross, just to clarify, the write-down in nickel post-tax, $2.5 billion in West Australia nickel. Now, by way of context, nickel, of course, is the smallest business by some margin within the BHP portfolio. But given the glut of supply that we've seen come in from Indonesia and nickel in the past 12 months, that forced us to step back and reassess the carrying value of that business. That's resulted in the impairment that we've seen. This was a loss-making business, or it remains a loss-making business for BHP. And so what we've said is that we're in active considerations around whether we move this asset into a period of care and maintenance, whilst that oversupply in the market works its way through the system, which could take until towards the end of this decade, beyond which we expect demand to catch up with supply and things to look more positive for the nickel industry overall. That's a consideration underway as we speak, and that's a decision that will be months in the making, certainly not years in the making.
And is that decision swayed by any move by the governments, federal or state, in regards to what they do with royalties, in regards to whether they give you credits for production?
So what we've said, and we've been pretty consistent on this in recent years, is that the single biggest thing that we all need to focus on is whether we've got the policy settings right to support long-run competitiveness, keeping in mind that in a number of the other metals and minerals, including nickel, copper, lithium, and so on, Australia isn't quite as naturally gifted as we have been in iron ore, coal, LNG. And that just means that we need to have an even sharper focus on what's required for us to be able to compete globally. And that comes back to fundamental policy settings. Now, that's not where the nation is at currently. It takes time to shift those policies. And in the intervening period, I'm sure there will be active consideration on the part of government as to whether there's other measures that need to be adopted to ensure ongoing investment, that operations don't get shut in. Now, as to whether the things that have been reported upon and are being considered will be enough to change the trajectory for the industry, keeping in mind that a number of other industry players have already moved into care and maintenance, is yet to be seen. We are looking first and foremost at self-help. So how do we go about ensuring that we're able to operate our businesses as effectively as effectively and productively as we can, given the things that are within our control? To the extent that there were further measures being taken by government, those will form part of the consideration. But I wouldn't want to call now as to whether that would be enough to change the direction of any decision that ultimately gets taken on that care and maintenance question that I mentioned. And I just do want to note that in addition to the technical considerations that we have around the move into care and maintenance, this is 3,000 plus people, and we take that very seriously. And it is one of the considerations that we have when we think about the different paths forward for the Nickel West asset.
Okay, so as you make that consideration as to whether you move those operations onto care and maintenance, what role does the government's industrial relations changes make on that? Does it move it further down the curve, backwards on the curve? Where does it leave it? Because quite clearly BHP has vigorously been outspoken about its concerns about the changes to not only labour hire policy, but then also the treatment of casual workers into the future.
So, Ross, we have been very clear in public in our view that some of the changes that have been put in place recently on the industrial relations front aren't going to help with that competitiveness question that I raised. However, I also want to be clear that that's not what is driving the challenges that the nickel industry is facing currently. This is all about more supply coming out of Indonesia, which simply serves to highlight the point that we need to have the settings in place that allow us to operate at maximum productivity and to compete globally. I do want to take one step back from nickel, however, and just set the scene for BHP overall. we have to keep in mind that this was a strong half overall operationally and financially. EBITDA was up by 5%, net operating cash flow up by 30%, balance sheet remains strong, 72-cent dividend. So notwithstanding the direct challenge that we're facing in the nickel business, a small part of the BHP portfolio, the overall business is performing quite strongly. And we've matured our kind of pipeline of growth options along the way as well, some of which are here in Australia. And this point around competitiveness will play a role in the decisions that we take in future around whether to deploy further capital into growing copper in South Australia, for example, which has to compete against the other options in the BHP portfolio in Canada in potash and in copper and in Chile.
I was going to ask you specifically about the South Australian copper, because that is a decision that is to be made imminently, at least anyway. The second part about this is you continue to drill in that Olympic Dam area with success there, so you know the resource is actually always going to be there and is growing. But then it comes to the consideration of the many billions of dollars you would need to be able to expand and extract that. And that goes to all of these other settings about Australia as a competitive place to invest and to do business and to get a return on.
It does, but what a wonderful story in South Australia copper, where the ongoing work over many years now to stabilize the Olympic Dam operation. We've had a new discovery at Oak Dam. We very quickly consolidated the Oz Minerals copper assets there, Carapatina and Prominent Hill. We're unlocking synergies at an even quicker rate than we had originally planned for. And now we've had the Olympic Dam Deeps drilling results. So that gives us a lot of optionality to underpin an expansion of that business to over 500,000 tons per annum of copper, but we're still working the numbers. I have to say the state government engages very constructively with business and is very inviting of further investment. I would say the same thing about their colleagues in Western Australia. But as to whether the numbers come together basis our own plans around capital expenditure, ongoing OPEX and so on, and whether the policy settings are there to support the competitiveness and productivity that we need to have in the business, that's still to be seen. And this is a decision that we'll take in 2026, 2027. But between now and then, we're working with government stakeholders and internally to try to ensure that we give South Australia Copper the best fighting chance to compete for capital within the BHP portfolio.
You talk about that competing for capital, and that's real. And you did mention earlier the Jansen 1 and 2 projects, which are in Canada right now. So you're in a unique position to actually make this observation. When it comes to competitiveness, Australia versus Canada, the ease with which a project can be got up and to be actually successful for you, how do you rate them both at the moment?
So I've been very clear in Canada that the government there has worked very well with business at both the federal and the provincial level, very inviting of investment, and where we've seen policy settings on a range of fronts being very stable. And at the end of the day, this is about risk and returns. The underlying policy settings and how well they support productivity goes to returns. Uncertainty around policy or unanticipated changes in policy goes to risk. And the settings, as is evidenced by the fact that we've pulled the trigger on a second stage of Jansen now, in Canada we've seen as attractive. Now, here in Australia, as I said, we're continuing to work through the options that we have in South Australia Copper. In Queensland, where we've deemed both the returns and the risk to be too high, we've said we're not investing further growth capital in that business. We will, and this is in the interest, Ross, I would say, of 17 million Australians who hold shares either directly or indirectly in BHP. Our success as a business underpins retirement savings for 17 million Australians. It's in everyone's interest that we're pursuing the best returns, risk returns profile for the projects or the options that we have within the company.
And can I also ask you about another risk in the business, and that is the Chinese operations in regards to the sale of iron ore, which creates steel, which creates the infrastructure for there. Given the really significant slowdown in its construction and building industry there, the collapse of the property sector, does that mean some of your focus maybe in the longer term has to go off the reliance on China? And I notice that India, say, for example, has given you reasonable returns, at least in this period of time.
The outlook for India is very positive, and I was there a number of months ago and came away very optimistic and excited about what we're seeing on the ground there. Having said that, just coming back to China, in spite of lower growth in the last half or the last year than many were anticipating, commodity demand has held up quite well, actually, and that's because the segments of the Chinese economy that are doing well, infrastructure, green infrastructure, machinery, automobiles, including exports, are all metals and minerals intensive. What we're saying about this year is that we expect growth in China to be between 4.5% to 5%. Upper end of that range will require a quicker and more effective translation of policies into consumer and business confidence. That's been lagging so far, and you see that manifest in the property market. But even at the lower end of the range, we expect China and India combined to continue to be major contributors to demand for the commodities that BHP produces. And at the same time, we expect to see a stabilization or maybe even a little bit of an uptick in demand coming out of other economies. So overall, balanced picture for commodity demand over the course of the next 12 months between China and India on the one side, other economies on the other side. And our underlying business operationally is performing quite well, as you can see in this set of results. So we're well positioned both for the near term and certainly for the long term, where our portfolio now is quite leveraged to the big mega trends that are playing out in the world around us.
Mike Henry, always good to chat to you and get an update of all of that stuff. Many thanks for your time as always.
Thank you, Ross.